Now the next topic that we're going to cover in this course now is a topic in finance we call capital budgeting. And this is a major topic in finance, just like cost of capital is, and all these topics really. But capital budgeting is one of the decision-making kind of processes that we go through in finance. Finance is often called a decision-making discipline, and that's true. And capital budgeting is the process we go through to make a lot of decisions. Now, capital budgeting, the word capital again in finance usually denotes something long-term in nature, something that goes on for more than a year. Capital budgeting is defined as the process of planning expenditures whose returns are expected to extend beyond 1 year. Capital budgeting. And there's some terminology in capital budgeting that I want to go through right now, just so that as we get later on into these videos, you kind of understand what it is we're going to be talking about. Now, one term that you hear quite a lot is the term of mutually exclusive. Projects are either mutually exclusive or they're independent. Mutually exclusive means that if you choose one project, you automatically reject all the other projects. If we were going to get a new fleet of trucks and we took bids from Ford and Chevrolet and Nissan or whoever, and we decided to go with Ford, well, by choosing Ford, you automatically eliminate all the other projects, all the other alternatives. And indeed, those would be mutually exclusive projects. You'll see later on as we talk about different capital budgeting techniques, it's important sometimes to know whether the projects are mutually exclusive or independent. Kind of helps you to determine which technique to use. But mutually exclusive, that means if you choose one project, it means the rejection of all the other projects. If projects aren't mutually exclusive, they're what are called independent projects. That means that the acceptance or rejection of one project has no impact on the acceptance or rejection of any other project. So whether or not we buy a new fleet of trucks has nothing to do with whether we buy the competitor down the road over here. Those projects would be said to be independent of each other. They're independent projects. So again, mutually exclusive projects or independent projects. All projects are either mutually exclusive or independent. The word sunk costs. Now, a sunk cost is an expense that's happened in the past. For instance, if we had a plant and we had property next to the plant, and our attorney told us we need to put a fence around the property so that people don't come out there on the weekends and, four-wheeler or whatever on the property and hurt themselves, they'd sue the company. So we put this fence out there. Years later now we decide we're going to go and sell the plant, and they come out and they value the property and the plant and everything else, and they say it's $6 million. I can't then go to them and say, well listen, that's great, that's $6 million, but it cost me $40,000 to have this fence put in a few years back. I want you to pay me $6 million plus the $40,000. That $40,000 will be looked at as a sunk cost. It's irrelevant, basically, in a capital budgeting project. On the other hand, if I were going to sell the plant and the new owner said, we'll pay you $6 million if you get rid of that fence, and it cost us $20,000 to get rid of the fencing, well, they would then pay us the $6 million plus the $20,000. Removal of the fence wouldn't be a sunk cost, it's a current cost. So again, this is a sunk cost. In capital budgeting, sunk costs have no place. We don't use sunk costs when we're coming up with the investments and all the cash flows. That's technically a sunk cost is a cost that occurred before time period 0. That's in the past, it's irrelevant. There are 3 kinds of cash flows that we're going to look at in capital budgeting. The present value of the outflows, operating cash flows, and terminal cash flows. Now I'm going to tell you what these things are right now. Trust me, We're going to get further into depth with this a little later on in the series here, but right now I just want you to know what these are. Students, people often have trouble with capital budgeting because they don't know how to process all the information about a project. Now, to me, it helps a bit to know that there are only 3 categories that the cost, that the information could go into, the financial information. It either goes into the present value of the outflows, the operating cash flows, or the terminal cash flows. Now, the present value of the outflows, often referred to as the initial investment. This is any cost, any expense that occurs at time period 0. These are the costs, the expenses of getting into the investment, getting into the project. Operating cash flows, on the other hand, these are cash flows that impact the income statement. And you'll see later on in a video where we will use an income statement to calculate operating cash flows. And again, it's any cash flow that impacts the income statement into the future. Terminal cash flows. These are the cash flows that occur at the end of the life of the project. You know, the machine we buy today, we sell 10 years from today, you know, we get a salvage value for that. That salvage value now is part of the terminal cash flows. And when we sell assets in the future, we often have capital gains, depreciation recapture, there's tax consequences to all of that. All of that's going to get kind of folded into what we call terminal cash flows. As a student now, remember in capital budgeting, only 3 different types of cash flows. We've got the present value of the outflows or the initial investment. We've got operating cash flows, which are any cash flows that impact the income statement. And we have terminal cash flows. And these are cash flows that occur at the end of the life of the project. In just a moment now, I'm going to show you in the next video actually, I'm going to show you another thing that we kind of run into in capital budgeting. It's called working capital. It's a little bit more complicated, the explanation of it, and we'll do that in the next video. We'll talk about working capital.